What if I told you the single biggest reason most traders fail is because they're asking the completely wrong question? Seriously, today we're going to tear down this whole myth of prediction and rebuild your entire approach on the rock-solid foundation of probability. Trust me, it's a shift that changes absolutely everything. So, let's dive in. You've probably heard this terrifying statistic before, right? Why do 90% of people, armed with the best charts, the fastest news feeds, all the tools, still end up losing money? Well, it's not because they need a better indicator or some secret signal. It's because they're stuck in a trap, and most of them don't even know it. And that trap? It has a name. We call it the prediction trap. It's just human nature to want to know what's going to happen next. But in the world of trading, that instinct isn't just a little bit unhelpful. It is the number one reason for failure. Period. And this right here, this is the whole game in a nutshell. The average retail trader is completely obsessed with one question: where is the market going? They need to be right. But the professional, they're asking a totally different question: what is my risk? They're obsessed with managing what happens if they're wrong. That one little shift in focus changes everything. Okay, so why is trying to predict the market a losing battle right from the get-go? I mean, really, why is it impossible? Let's actually look at the hard facts that prove trying to find certainty in the market is just, well, it's an illusion. This quote from Nobel laureate Eugene Fama really gets to the heart of it. What he's saying is, by the time you see a pattern on a chart or read a piece of news, guess what? The market has already priced it in. The information is already reflected in the price. You're always looking at a snapshot of the present, never a crystal ball into the future. And think about it. The market isn't some single entity moving with one purpose. No way. It's a massive, chaotic ecosystem. You've got millions of traders, banks, algorithms, all with different goals, different timelines, and different reasons for buying or selling. Trying to predict the one single outcome of all that chaos, it's like trying to predict exactly where a single raindrop is going to land in the middle of a hurricane. Good luck with that. The great trading psychologist Mark Douglas just nails it here. Every single moment in the market, every trade, is a unique event. It's totally independent of the last one. Your last big win doesn't mean you're more likely to win the next one. Your last loss has zero impact on what happens now. The market has no memory, and believing it does is one of the most expensive mistakes you can make. All right, so if prediction is the villain of our story, then who's the hero? This is where we make the pivot. We're going to stop chasing the ghost of certainty, and instead, we're going to build our entire trading strategy on the only thing that is real and reliable: probability. Now, let's be super clear. Probability is not about knowing what will happen on the very next trade. It's about knowing what is most likely to happen over a huge series of trades. We're talking hundreds. It's all about finding a small, consistent statistical advantage, an edge, and then just playing that edge over and over and over again. And this quote from trader David Paul sums it up perfectly. Your goal isn't to be a genius who's right about this one trade. Your goal is to be a disciplined operator who just executes a strategy that you know has a positive statistical advantage over and over again. You trust the math, not the magic. This is the exact point where most traders fail. They'll try a new strategy. It'll lose 3 times in a row, and they'll throw it in the trash, saying this thing is broken. But as the legendary coach Van Tharp always said, a real trading edge only shows up over a large sample size. We're talking hundreds of trades. Anything less than that is just random statistical noise. So, this all sounds good in theory, right? But how do the pros actually use probability to make money if they're not predicting the future? Well, they use a simple but incredibly powerful mathematical tool. You could almost call it their hidden weapon. And that weapon is called expectancy. It's not a crystal ball, it's not a guess, it's just cold, hard math. It's a formula that tells you, with your current system, whether you have a positive edge that will make you money over time. It's the mathematical proof that your edge is real. Now, the formula might look a little intimidating, but the idea is actually super simple. It's just a balancing act. It recognizes that it's not just about how often you win, it's about how much you win when you're right compared to how much you lose when you're wrong. Let's make this real with an example. Okay, let's imagine a trading system where you only win 40% of the time. Yeah, you heard me right, you lose 60% of the time. Sounds terrible, doesn't it? But here's the key. When you win, you make 3 times what you risked. We'll call that a 3R win. And when you lose, you only lose your initial risk, or 1R. So let's run the numbers. And there it is, a positive expectancy of 0.6R. Now just let that sink in for a second. Even though this system is wrong 60% of the time, over the long run, for every single dollar you risk, you can expect to make 60 cents back. You can be wrong more often than you're right and still be wildly consistently profitable. That's the power of math. And this is exactly why chasing a high win rate is such a dangerous trap. Look at strategy A. On the surface, a 70% win rate looks amazing. But because its wins are tiny and its losses are big, it's actually a losing system over time. Meanwhile, our losing strategy B, the one that only wins 40% of the time, is the real moneymaker. And it's all because of its powerful risk-to-reward structure. The legendary trader Tudor Jones just sums it all up perfectly. True, lasting profitability doesn't come from hitting home runs and chasing massive wins. It comes from playing great defense, from protecting your capital and rigorously controlling your losses. That's what allows your probabilistic edge to do its work over time. Okay, so the math checks out. Seems simple enough, right? Well, here comes the really hard part. The biggest challenge for any trader is overcoming our own brain, which is literally hardwired to fight against this entire way of thinking. And we're back to Mark Douglas, because he absolutely hammers this point home. It's our ego. We have this deep psychological need to be right. But in trading, needing to be right on every single trade forces you to do all the wrong things, like cutting your winners short out of fear and letting your losers run in the hope they'll come back. It completely destroys any mathematical edge you have. And look, it's not even really our fault. For thousands of years, our brains evolved to survive by finding patterns, seeking certainty, and avoiding loss at all costs. Those traits kept us alive on the savannah, but they are an absolute disaster in the financial markets, which are fundamentally uncertain and random. To succeed, you have to consciously fight your own instincts. All right, so we've torn down the old broken way of thinking. Now what do we replace it with? Let's put all of this together and build a brand new, actionable playbook based on everything we've just covered. This is it. This is your new philosophy, your new set of rules. You stop predicting and you start planning. You define your maximum loss before you even think about entering a trade. You only hunt for trades where the potential reward is a multiple of your risk. And then you just execute, you repeat, and you stay emotionally detached because you trust the math over the long haul. If you take only one thing away from all of this, let it be this right here. This is the ultimate mental shift. After every trade, win or lose, stop asking yourself, was I right about the direction? It's totally irrelevant. The only question that matters is, did I follow my rules? Did I execute my edge perfectly? The outcome of any single trade is just noise. Your process is everything. And we'll end on this powerful thought. Anyone on the planet can have an opinion about where the market is going. But opinions are cheap, and they're usually wrong. The professional trader leaves opinion and ego at the door. They operate in the cold, clear world of mathematics, because that's where a real measurable edge actually lives. So the final question is, which world are you going to trade in?